Welcome to our channel, where we explore the world of investment and help beginners navigate the complexities of finance. In today's video, we'll be delving into an important concept called beta coefficients. Join us as we provide a beginner's guide to understanding beta coefficients and their significance in the world of investment. Let's get started. When it comes to investing, understanding risk is crucial. One way to assess risk is by using beta coefficients. Beta coefficients measure the sensitivity of a stock or investment portfolio to movements in the broader market. In simpler terms, beta helps investors gauge how much an investment's price is likely to move in relation to the overall market. Understanding beta coefficients. Beta coefficients are represented by a numerical value. Let's take a closer look at what different beta values indicate. 1. Beta value of 1. A beta value of 1 suggests that an investment is expected to move in line with the overall market. If the market goes up by 10%, a stock with a beta of 1 would be expected to increase by a similar percentage. It indicates an average level of risk. 2. Beta value less than 1. A beta value of less than 1 implies that the investment is less volatile than the overall market. If the market experiences a 10% increase, a stock with a beta of 0.7, for example, might be expected to rise by 7%. Investments with beta values below 1 are generally considered less risky. 3. Beta value greater than 1. A beta value greater than 1 suggests that the investment is more volatile than the market. If the market rises by 10%, a stock with a beta of 1.3 may be expected to increase by 13%. Investments with beta values above 1 tend to be considered riskier. 4. Negative beta value. Host. In some cases, an investment may have a negative beta value. This indicates that it moves in the opposite direction of the overall market. Such investments are often seen as a hedge against market downturns. However, it's important to note that a negative beta doesn't guarantee profitability. Applications of beta coefficients. Host. Now that we understand beta coefficients, let's explore their applications in investment strategies. 1. Portfolio diversification. Beta coefficients help investors diversify their portfolios effectively. By including investments with different beta values, investors can balance the overall risk and return potential. Combining assets with low, medium, and high beta values can create a well-diversified portfolio. 2. Risk management. Beta coefficients aid in risk management by providing insight into an investment's sensitivity to market fluctuations. Investors can adjust their portfolios based on their risk tolerance and desired level of exposure to market movements. 3. Performance comparison. Beta coefficients enable investors to compare the risk and performance of different investments. By considering beta values alongside returns, investors can evaluate whether an investment has provided adequate returns for the level of risk taken. Beta coefficients are a valuable tool for investors seeking to understand and manage risk in their investment portfolios. By analyzing beta values, investors can make informed decisions about diversification, risk management, and performance evaluation. We hope this beginner's guide has provided you with a better understanding of beta coefficients and their significance in investment. If you found this video helpful, please give it a thumbs up and consider subscribing to our channel for more insightful content on finance and investing.